Hello, this is Ken Tomko with T2 Asset Management doing our monthly review of what's going on in the markets. As always, please don't use these for trading purposes. They are for information only. Start here with the weekly chart of the S&P 500. This goes back to about late 2021 here on the left side. As you can see, here's our major trend line that's going up here. Market's just been in go-go mode. Put recent support at 7,200 under there. So the market keeps it came down and did a little test to start the year. It did the same thing in 25, but then it's going on. Had a nice big rally here the back half of the year. It's been kind of consolidating, as you can see, a little sideways for the last a couple of months, but still all healthy. Everything shows up. If we come down here in a little more detail, you can see this is the daily chart of the S&P 500, and this will give us about the last 2 years trading that we're seeing. And I put on here this wedge pattern, and that really highlights what markets tend to do when they're not certain which way to go next. So they'll do a little sideways, and it's funny, you get kind of a downtrending line, so a little lower highs and also a little higher lows as it just kind of consolidates sideways. Probably does reflect an upward movement. Sometimes the market will do that. It'll have a big blast higher, and rather than going lower, it'll just go sideways for a bit, and that's probably what we're seeing here. Suggests a move higher, but it's not written in stone. But markets are looking solid above all our major moving averages, trend lines up. Not really anything to see here that's going to have us pulling to defensive mode quite yet. Now, if we come over here to this is the 2 hour chart, gives us a little more detail, and you can see that wedge there. So it's really just been what is this? May last 2 months, basically just a sideways back and forth. Let's look at some of the internal measures here in the underneath the market. Now, this is the bullish percent, what they call the percentage of the S&P 500 that's in an uptrend. Right now, that's 61%. Are in an uptrend, 40 not. And so that's relatively okay. It's not really high numbers. You expect in big bull markets, you'd want to see that 80, 90 sometimes. But anyway, it's not terrible. Then if we go here, the next one down is the advanced decline line on the New York Stock Exchange, and that's been rising. And that it basically just takes advancing days or advancing stocks over declining stocks and puts an each day total. And you can see here for the year since early in the year, it's just been uptrending. So we are seeing just gains across the board in the on the New York Stock Exchange. Finally, the bottom here, this is the VIX, the volatility index, and this shows what people are paying for insurance premiums, puts that would pay if the market falls. And that premiums decline during market sell-offs, as you show here. The market's selling off there in March, right? And you can see kind of beforehand the things that we're looking at here, right? The bullish percent starts to roll quite a bit lower. The advanced decline line's going lower, and the VIX is going higher. And that's what we see during declines. And usually at the end of it, one of the first indicators will be the VIX here will start to fall. And that's what happened in this case. So that's why I look at these things. And right now the VIX is very muted, so it doesn't show that the market's very upset about anything. We look at some other indicators here, the ratio of consumer discretionary stocks to consumer staple stocks. That's a little sideways, but certainly not negative. And you see here in the beginning of the year when the market was declining, right, that rolls off. This one is a ratio of technology stocks to utility stocks. Same thing in declines, you expect it to fall, and in rallies here, you expect it to go up, and now it's sort of sideways as the market is for the last couple of months. Biotech to healthcare, same sort of thing. Biotech's roaring right now, so good sign there. And then the ratio of hotels to utilities, right? People stop traveling, stop doing that, and then say, okay, well, they're still going to need electricity in their homes and stuff. So utilities will always do well, no matter the state of the economy. finally, a little bit of, and had a little bit of a decline this week. And let me see if I can highlight that. It started to roll off just a little bit, and I believe the impetus for that was that interest rates started moving a little bit higher. We definitely are still in this sideways range, this 4.5% on the 10-year Treasury. Just keeps saying, and this is more of a weekly, right? This is going to give us, this giving us 10 years data. So really for the last 3 or 4 years, the interest rate has just been staying right in this 4%, mid fours range. It started to move a little higher this week, and that was causing some people to get maybe a little concerned. But now it seems to be declining back off of its highs. So that's a good sign. Let's see. Next, we have, and this is the only real concern out there is with earnings. This bottom chart here this is the earnings in the S&P 500. So they've just been rising, right? And earnings have been good. They've been rising and rising. The problem is that the market is really overvaluing what those earnings are. A normal metric for earnings on the S&P 500 would be, call it 20 times earnings would be about average. And that's what this is right here, 46.81. Right now, the S&P is at 75.32. So we're getting close to double what it should be for 20. So it's very expensive, very overvalued. Terrible timing indicator, as I've said before, but just something to be aware of. Then finally, if we kind of look at some of the fundamentals, let's look at the economics. GDP growth rate. The previous reading had been 0.5%, but last one was 2.1. It's not so bad. Non-farm payrolls. We had the previous was 129,000. Last one here is 57,000, but that's still positive. Nothing really going wrong there. I don't like to see the inflation rate here creeping up. We're hitting 4.2, and that's probably why interest rates were going higher, because we just got a new Fed chairman, and he may be a little more hawkish than people think. Hawkish being keep interest rates higher to tamp down on inflation, because inflation's coming back again, as anyone knows who leaves their house to buy anything. Then finally, retail sales here. It's not super strong numbers, but they're still positive. So nothing to really see on the economic side. So what we're looking at is a market that, yes, is going sideways here for a couple months and gives us, you get a couple scary weeks or something like that, but nothing really too much yet. It's just in a sideways motion, which actually can be a great place to put to covered call strategies and such to work income basically while it goes sideways and figures out what's next. But as I said, this pattern does suggest that we'll probably have a move higher. Just kind of consolidates sideways and then moves on from there. So anyway, hope this was helpful and informative. I'm going to put up our contact information here. If you have any questions, like to hear about what we're doing in our portfolios, talk about that, then please do reach out anytime. Otherwise, hope it was helpful and informative again, and I will, thanks for watching. We'll see you at the next update. Thanks so much.